Good morning, everyone. So today is the day before the exams opens. As usual, I'll keep it open for 3 days and give you some time to take it or take it right away if you want. Um, the exam is going to cover just cash and cash equivalents. It's going to cover bank recs. It's going to cover accounts receivable, and it's going to cover just a little bit of notes receivable. And if I was to say, like, in terms of where the most points are, definitely in our accounts receivable, there's more topics. And so that just lends itself to more questions and more points. Um, the next would probably be cash and equivalents and bank recs. Bank recs having a little bit more because I put a problem with bank reconciliations on there. But you will have some cash and cash equivalents by the way of multiple choice as well. And definitely coming in last would be notes receivable, which only have one problem that's kind of small and not worth a whole lot of points. I think 6 at the most, maybe even just 4. And then maybe 1 or 2 multiple choice questions about them. So today I wanted to start off with looking at a problem that was in assignment 8, and I think would be beneficial for us to talk about because it ties together some noteworthy concepts. And this is this gemstone products. I have it shared on the screen right now. The gemstone products problem 7.5. It was the 4th question on the assignment. And it's an algorithmic problem. So this isn't necessarily the numbers that you saw. It just automatically draws a random slew of numbers every time it creates the problem. This isn't a problem that kind of hits at a higher level. And a lot of it is because we're no longer just simply relying on journal entries any longer. Just some sort of memorized process of I debit this, I credit that when I'm in this situation. But it actually forces you to really think through not just the journal entries, because you need to know those in order to do this problem, but also like how things are affected, how they correspond to the financial statement presentation. And so basically what we get here is an excerpt from a balance sheet and a disclosure note about receivables, and then a little bit of extra information about the receivables themselves, like some transactions that happened that we couldn't necessarily ascertain without being told. And when you get this sort of prompt, the best way to go in my opinion, is T accounts, because T accounts will help us analyze the transactional data that are occurring, but you need to understand how to create the T accounts from the information you're given in order for that to be an effective strategy. And but that is really kind of what we're working you toward. This is more of an accounting analysis question rather than just a bookkeeping question. So for example, we got a beginning or we got 2 balances of receivables at the end of the year. And the very first thing that we need to understand, of course, is that this is at their net realizable value. So this is the value of these receivables after we've subtracted off allowance for doubtful accounts and allowance for sales returns. And we have some additional information. And in fact, this disclosure note goes so far as to give you that reconciliation. It shows you that, all right, we started with, in 2015, $530,780 of receivables, and we subtracted off an allowance for doubtful accounts of $77,840. We subtracted off a reserve for returns of $11,340. And this resulted in $441,600, which is the amount that we have here presented in the balance sheet. So that's a way of helping us realize that this is a balance sheet with net realizable value. If you were to add 77,840 and 11,340, you would come up with the total amount of allowance that was subtracted per the balance sheet's verbiage, $89,180. So connecting that information, being able to reconcile that information is important for your total understanding of what's going on. Now the question becomes, well, how do we convert this to a balance sheet? So I'm going to write some of this information down on my camera and or on a piece of paper, and then I'll switch over to camera. All right, so this is my net realizable value for 2015 and 2016. These are my receivables amounts and their net of allowances. So I didn't copy down the disclosure note just so that I can kind of make this from just the basic stuff that we would get from any company's balance sheet. We wouldn't even have to go to that footnote that tells me, well, how much precisely was sales returns and how much precisely was allowance for doubtful accounts, just to begin our process of transcribing to journal to T accounts. So with the accounts receivable balance, since these are balances, then they translate to the balances in my accounts receivable. That is the beginning and ending balances of accounts receivable. However, because this is NRV, net realizable value, which means that we know that it's net of these amounts, we know that it's net of something, which is my accounts receivable balance, less the amount that was in the allowance. And so we can create an equation that's really easily backed it out of. For example, 2015, the net realizable value was $441,600, and that equals whatever the amount of receivables I have minus 89,180. And so in order to find the amount of receivables, I would just add that back to my amount. It's done for me in that disclosure note that I showed you, because essentially what they're doing with that disclosure note, I'll go back to that screen here for just a moment. What they're doing for that disclosure note is just taking the 44,600, and then if you added back 11,340, added back 77,840, you will get the answer, which is 537.80. But I'm just going to do it on my equation so that we're not depending on that necessarily. So if I add 89,180 to 441,600, bring that over to the other side of the equation, then I get that $530,780 is my X. That is the amount of receivables that would be reported. Now, so that's a balance of receivables. And because we're talking about what happened during the year 2016, like right here, all this stuff that's going to happen is during 2016, This is where we started 2016 at. That's that 12/31/15 balance. And then this is where we're ending 2016 at. That's the year-end balance. So I now have where I'm beginning $530,870. And I can do the same thing to this side. I know that this is net of the allowances that total up to 133,580. And so if I just add that amount back using a same idea that I did here, put 462,100 over here and solve for X, subtracting off 133,580, then I'll get the end balance, which should be $595,680. So that is the amounts that the first question was looking for. It's just asking you simply, what is the amount of receivables that are due from customers at the end of these 2 years? And you could have gotten it as simply as just pulling these two numbers, but that's not really that effective unless you understand the whole process, which is why I solve it out here on this paper and wanted to write it out a bit more, because then the next things become a little bit more dependent on our ability to draw from the information that's coming in the problem with these particular accounts. So that's the accounts receivable accounts balances. We also have information about the balances of our two contra accounts, the reserve and the allowance. So if we have our allowance for doubtful accounts and our allowance for sales returns, it started in 2015 using that idea of a balance. The ADA, allowance for doubtful accounts, started in 2015 at 77,840. And you know it has to be a credit balance. And there's a couple of things that tip you off to that. Well, first, here's an asset. And if we're reducing it by an amount from an account, then that means that that must be a contra asset because we're reducing it by this amount to get what I'm presenting on the financial statement. So it started at 77,840. It ended at 123,140. So I'm filling that out on my paper with my T account on the credit side of ADA. And then I do the same thing for ASR. The ASR started at 11,340 and ended at 10,440. All right, so the other things I'm going to copy down just so they're on the paper as well, and I can stop sharing my screen, is the amount of bad debt. So I got a bad debt expense that I know I estimated and recorded, and that was in this problem 192,600. I have an amount of products that were returned and they totaled 187,240. So these are actual returns. And my net sales were 5,658,800. Okay, so questions are, what amounts of accounts receivable did they write off? What was the amount of the gross sales? Because it gave us net sales. So it wants us to add back whatever amounts we need to get gross sales. And then finally, assuming that they're made on a credit basis, all sales are made on a credit basis, what is the amount of cash they collected from customers during the year? So we're looking for a few things up in these T accounts and using this information. So where do we go next? Basically, what we need to do is start filling out the T accounts with the transaction information that we have here. We already have some knowledge of what's going on as the beginning and ending balances from those disclosure notes, but the rest of it is kind of getting into the context. So when I get into bad debt expense, how does that fit into my accounts up here? What does it affect? And you have to have a working knowledge of the journal entry to know that the journal entry of this would have been a debit to, I'm going to make it an acronym, BDE, bad debt expense, 192.6. That would reduce my net income. And I would credit ADA, which reduces my assets for that amount. So bad debt expense causes ADA to increase, it credits that amount. So one of the things that must have happened to get me from this balance to this balance is that I credited my ADA by $192,600. Actual returns, what does that look like? Well, when we have an actual return and we have a balance up in our ASR, then, or we're using an ASR, what we want to do with that would be to debit our ASR and credit our accounts receivable. Accounts receivable gets the full credit, 187,240. And we also have that amount to my ASR. For the net sales, that is going to look like, it says, assume that all these are on credit. So 5,658,000 would be debited to my accounts receivable account and credited to a sales revenue account. Now notice I'm not keeping track of any T accounts for my nominal accounts. And a lot of that is because the beginning and ending balances of nominal accounts are always zero. So the expense, for example, I don't track in a separate T account. The sales revenue, similarly, I do not track in a separate T account. All right. So now that I have that information, I want to go ahead and update my T accounts for what I recorded here. This 187 reduces my ASR with a debit. This debit to accounts receivable increases it. And now we have a little bit more information as to what's going on in this problem. Remember that the first question, or it's actually the second question, it said how many customer accounts were written off? And one of the things that, or how can we figure out how many write-offs we had? And when we're looking for write-offs, then we also have to understand what that journal entry is in order to figure out where we might find that information. So a write-off under the allowance method says that I reduce my ADA and I reduce my accounts receivable. So we're looking for this number, and we know it's a reduction to both of those accounts. And now I have to figure out where the smarter play is. Where do I want to go to figure that out? Well, with accounts receivable, the problem becomes that we have other things going on here. We have write-offs affect accounts receivable, but so did the actual returns. In fact, I forgot to put the 187,240 over here. We have write-offs that certainly come in here, but we also have collections. And so we have two unknowns here in this T account, but we only have really one unknown going on over here because we know that write-offs reduce my ADA balance. And so really what it turns into is solving for X here. What amount of a debit forced by a write-off would make it so that 77,840 plus, or increased by 192,600 would net me 123,140. So that math doesn't work as is, because 77,840 increased by 192,600 is 270,440. And so I want it to come down to this number. So in order to do that, I have to reduce it by 147,300. So that must be the amount of write-offs that I had during that year. We're going to get to the gross sales, but not yet. That's like the next question. We'll take it one at a time for now. And then this also translates over into my accounts receivable. And that gives me another piece of the accounts receivable account that I did not have before. And you don't need that gross amount for accounts receivable, simply because what it's net of is sales returns. And we do not, this number is recorded only net of discounts if we're using the net method, but otherwise is reported prior to sales returns. So accounts receivable is unaffected by sales returns because it's already being reduced by our estimate for sales returns. So if I subtracted sales returns from my sales, in addition to having this estimate for sales returns, I'd be subtracting them twice. All right, so we got that piece, we got an extra piece. We still need the cash collections. That's what we're missing here. And the next piece tells us about the gross sales to ADA. So in order to figure out the gross sales, remember that net credit sales is a product of really three things. If we are using the gross method, then it's going to be my gross sales minus any sales discounts minus any sales returns. This is the using gross method. And when I say gross method, remember I'm talking about the cash discount accounting. Using the net method for cash discount accounting, we already deduct any sales discounts from what we record as our sales revenue. So then it's, well, and I say gross sales, maybe I should just call it sales revenue. But since if we use the net method, it already reduces sales revenue. So this is already recorded net of discounts. Then all we have to do is subtract off sales returns. Now, one thing that this problem doesn't have stated explicitly, which I think it should, is that the company must be using either a net method approach in recording cash discounts, or they just don't offer cash discounts. Because if you don't offer cash discounts, the net credit sales will always just be sales revenue minus sales returns. If you do offer cash discounts, then remember you have two acceptable ways of doing it. Either you do the gross method where you record sales revenue at their full amount, and then as people do not act within the discount, we record sales discounts that we subtract off of it. And then if we have sales returns on top of that, we subtract that as well. Under the net method, the company records all revenue under credit sales already net of discount because we assume people are going to take the discount. And then all we have to subtract off on top of that is sales returns. So these are the pieces that we're dealing with in this particular problem in order to figure out, well, what is my gross sales? So they told me that my net sales were 5,658,000. So I know what's on the left-hand side of the equation. And what I'm looking for then is what amount of sales returns must have been made in order to get this number here, because this is now the answer to my, what is the gross sales made? So I got that equals X minus, and now I'm looking for the sales returns estimate. So how am I going to find a sales returns estimate? Again, I want to return to these accounts here and think about, well, when I record an estimate of credit sales, record an estimate of returns on credit sales, what is affected? So I have a debit to sales returns and a credit to my allowance for sales returns. So when I estimate sales returns, it increases my allowance for sales returns. And that lets me figure out something that's going on in here, because if I only reduced my ASR by the total amount of returns that were made during the period, then I wouldn't come up with a credit balance of 10,440. It would be 176 or 66 or $167,000 of a debit if I just took 11,340 and reduced it by this amount. And that's not what I have. So I must have had an increase to this account, and that increase to the account fits in with estimating additional credit sales. And then again, I just do some math where I say, all right, if I took 11,340 and subtracted off 187,240, then I would have a debit balance of 175,000. Oh man, my math was terribly off, obviously. 175,900. But I ended up with this balance. So what would I have to do in order to get it up to 10,440? Well, I would have to completely zero this out. So that would be $175,900 of a credit. And then that would only get me to zero balance in ASR. Then I have to add in another 10,440 to get the appropriate credit balance. 186,340 is what it's telling me that would allow this account to appropriately reconcile with these entries. And so that is the amount of my estimated sales returns for the period, $186,340. And again, just solve for X. If we're subtracting off 186,340 to get to 5,658,800, then I just want to add 186,340 to that amount. And so my total amount is $5,845,140. And that is my gross sales revenue. And the unstated assumption in this problem, like I said, is that we're either using the net method so that this amount here is already net of sales discounts, which is exactly how I would record it as debit accounts receivable, credit sales revenue, or we do not offer cash discounts. So there's no cash discount for a prompt payment. And this is just the amount that would be recorded in accounts receivable. But I felt like that was something that's missing from the problem, because otherwise you have this sort of lingering doubt as to what is going on with sales discounts, or you could if you were really considering it deeply. All right. The final piece is for the collections. And we basically could have solved that already, because that was the only missing amount here, is the amount of collections we made from customers. And so just doing the reconciliation, we have $530,870 debit balance that's increased by our sales revenues during the year. And then that is reduced by the actual write-offs, 147,300. It's also reduced by the actual returns, 187,240. And that would give me, if I just consider that information, a debit balance of 5,855,000. Did I do something wrong? I don't know. Oh, someone just solved it for me. Thank you. But that would be what I would get as a debit balance, but that's not what I have. And so in order to figure out what that debit balance needs to be, I subtract, or that collections needs to be, I subtract off the debit balance, and I get 5,259,450, which is slightly off from what my online student said. So let me just make sure I did this right. 530,870. Connect does give you sometimes a plus or minus percent, but just in case, I might have fat fingered my calculator here, or my phone, not really a calculator. Let's look at the 450. So I mean, we're off by $90. Me and the student. So that's all right. All right. So then that's the amount that I would put in there: 5,259,450. And that would be the amount of collections I made. And so, like I said, I like this problem. It combines a lot of things. It makes you really think deeply about how the financial information, the disclosures, the additional information we have fits into the T accounts. It approaches the whole problem, like all our knowledge, from a slightly different direction. And it also necessitates us to understand, well, the foundation of the journal entries and how they influence the accounts, how they increase and decrease. What becomes much more useful in your studying and in linking this stuff together is, no longer just relying simply on, okay, how do I make a journal entry out of this, but also understanding what transactions affect the T account as a debit or a credit. So for example, and I wrote this out before on Tuesday's class, like accounts receivable, debits to accounts receivable, what do those reflect during the period? Well, they reflect credit sales. They can reflect reinstated accounts. What do credits to accounts receivable tend to reflect? They reflect collections, write-offs, actual sales returns, recoveries of reinstatements. What does ADA reflect? Debits and credits. Debits are reinstatements. Credits are bad debt expense. There's a lot, I'm sorry, debits are write-offs, credits are reinstatements and bad debt expense. So getting that knowledge and that narrative about what's debiting and crediting accounts, in addition to the journal entries, really starts to help inform and link the numbers together. Oh, so I flipped those two numbers. Okay, thank you. So I appreciate the audit of my digits, what I really hope is also being heard though is all of these idea about higher level concepts as well. So that you're not like focusing on a tree in an immense forest of stuff. All right. Any questions? All right, so that is that particular problem. And I just felt it really kind of illustrated a nice high level concept.